Welcome to The Explainer. Today, we're diving into one of the most wild, earth-shattering financial events of our entire lifetime. Literally, the bank that broke the world. We're going to do a complete autopsy on a 158-year-old titan, Lehman Brothers. This isn't just some boring story about a bank failing, okay? It's a massive, crazy story about how unchecked confidence and, honestly, extreme risk-taking brought the entire global economy to its knees.
I mean, just look at this number. $639 billion. That's billion with the B. That is the staggering amount of reported assets that just vanished into thin air. Poof. And when that much wealth evaporates, it doesn't just hurt a few guys in suits on Wall Street. It triggered a catastrophic global meltdown that hit everyday people, wiping out retirement accounts and taking away homes all over the world.
Okay, let's dive right into this exact date. September 15, 2008. If you were paying attention to the news back then, you probably remember exactly how it felt. That was the day Wall Street woke up to an absolute nightmare. Literally overnight, thousands of dedicated employees found themselves completely jobless, walking out of skyscrapers carrying their stuff in cardboard boxes. Investors were in sheer panic, and markets were crashing in ways we hadn't seen in generations. Within days, the whole world economy was practically in a freefall. Let's jump into Section 1, Birth of a Titan. 15 years of resilience.
Right, so to really understand the sudden, shocking death of Lehman Brothers, we've got to look at its legendary life first, because this was definitely not some fly-by-night operation that just got lucky. This was an institution built over generations. The whole thing starts way back in 1844. Three immigrant brothers, Henry, Emmanuel, and Mayer Lehman, opened this humble little general store down in Alabama, selling goods to local farmers. Well, pretty soon they figure out that trading cotton is way more profitable, and that naturally leads them into the world of finance by the late 1800s. Over the next century, these guys survived the American Civil War, 2 World Wars, and the Great Depression. So by the early 2000s, Lehman Brothers was a bona fide Wall Street legend. I mean, they had built this aura of absolute invincibility.
Moving to Section 2, the housing boom mirage, the illusion of perpetual growth.
But as we all know, invincibility is usually an illusion, right? Fast forward to the early 2000s. The energy in America was just frenetic. It was this era of overwhelming optimism and, let's be real, unchecked greed, especially in real estate. The market was in an absolute frenzy. Housing prices were skyrocketing to levels that totally defied gravity. Banks were handing out mortgages to practically anyone who walked through the door, including folks with really poor credit histories. And the foundational belief driving this whole crazy machine was simply that home prices would just keep rising forever. So Lehman Brothers sees this, and they decide to aggressively capitalize on the boom. They go all in, heavily investing in these mortgage-related securities, raking in absolutely massive profits, handing out astronomical executive bonuses, everybody's celebrating. But right beneath the surface, this hidden systemic danger was secretly compounding.
Which brings us to Section 3, the fatal bet, the danger of extreme leverage.
Okay, so this is the core mechanism of their downfall. Lehman wasn't just casually participating in the housing market. They were placing a massive, fatal bet using a highly aggressive financial strategy called leverage. What is leverage? Well, it's basically borrowing enormous amounts of money to purchase assets. It's the ultimate double-edged sword. When things are going great, it amplifies your profits to staggering heights. But when things go south, it amplifies your losses to devastating, fatal depths. And Lehman had become one of the most highly leveraged institutions on all of Wall Street.
And this brilliantly illustrates how it works. Imagine buying a $1 million house, but you're only putting down $20,000 of your own cash. The whole rest of it is borrowed. Now, if that house goes up in value by just 10%, you've made a massive return on your initial $20K. It's awesome. But if the value drops by just 2%, boom, your entire personal investment is totally wiped out. Lehman Brothers was making dangerously risky bets exactly like this, operating on the unshakable and totally flawed assumption that housing prices just couldn't fall.
Let's look at Section 4, House of Cards falls. The cracks begin to show.
Because we all know what happens to things that go up forever, right? Eventually, they don't. In 2007, the unthinkable actually happened. Housing prices completely stopped rising, and then they fell. The music just stopped. And this initial drop meant that Lehman's massive portfolio of leveraged mortgage securities started rapidly losing value. Suddenly, the assets backing all that borrowed money were worth less than the debt itself.
And as those prices dropped, everyday borrowers, who frankly had been given loans they couldn't actually afford in the first place, started defaulting. This triggered this terrifying rapid domino effect. Those mortgage securities basically became toxic. Credit markets, which absolutely rely on the smooth flow of money to function, just froze entirely. Banks looked around at each other and suddenly stopped lending, because nobody had any idea who was holding all this bad debt.
And then came the ultimate death blow. Confidence simply disappeared. Lehman's leadership actually went out to the press and insisted everything was totally fine, that they had the situation completely under control. But the market just wasn't buying it. And in the world of finance, confidence isn't just a nice-to-have, it is quite literally everything. Once people stop believing you can pay them back, that's it. It's game over.
Which leads into Section 5, the final days. No buyer, no bailout.
By the time we hit 2008, Lehman Brothers was bleeding money at an incredibly alarming pace. I mean, its stock price was in total free fall. They were holding these frantic emergency meetings behind closed doors with government officials and potential buyers, but nobody wanted to touch them. The government, which remember had actually rescued other institutions recently, made the unprecedented decision to refuse a bailout for Lehman. And just like that, it led to the absolute largest bankruptcy in American history. On September 15, 2008, an institution that had survived for 158 years, holding over $600 billion in reported assets, simply ceased to exist. Gone.
Moving to Section 6, the global shockwave, a worldwide crisis. Because the immediate fallout was just horrific. Banks completely stopped lending, millions of regular folks lost their jobs, retirement accounts shrank drastically, and central banks around the world were forced to inject trillions of dollars just to prevent a total economic collapse.
So what really caused this massive worldwide crisis? Well, there are a lot of different perspectives on who or what is actually to blame here. Honestly, we're looking at a perfect storm of simultaneous failures. Some experts point right to excessive risk-taking and corporate greed. Others strongly argue the primary fault lies with weak regulation and poor oversight. You've got some blaming the credit rating agencies for slapping safe labels on toxic assets, while others point directly to government housing and economic policies. And of course, underpinning the whole thing was that completely false belief that housing prices would grow forever. Now, we aren't here to take a side in a political debate. The reality, straight from our source material, shows us that all of these systemic failures basically converged at exactly the wrong time.
Finally, Section 7, Lessons from the Collapse, Understanding Risk Today.
So, the absolutely crucial point here is what can we actually take away from this? The 2008 financial crisis reshaped banking forever, but it also offers some seriously timeless wisdom. Let's distill these essential takeaways because they apply to any business or even your own personal financial strategy today. These 5 principles are absolutely foundational. Number 1, good times simply don't last forever. Markets cycle, always. Number 2, too much debt destroys. Leverage is super fun on the way up, but it is fatal on the way down. Number 3, you absolutely must understand risk before taking it. Don't invest in what you don't comprehend. Number 4, size doesn't guarantee survival. I mean, Lehman was a titan, but it wasn't immune to basic math. And finally, number 5, confidence is your most valuable asset. When trust disappears, even the strongest-looking institutions can collapse in a matter of days.
Which leaves us to the enduring legacy of Lehman Brothers. As the quote goes, success without discipline can be dangerous, and even the biggest institutions can fail when risk is ignored. Lehman's shocking collapse completely rewrote the rules of financial regulation, and it really serves as the ultimate cautionary tale of modern capitalism.
So, I want to leave you with this provocative thought to ponder. If a 158-year-old titan can vanish practically overnight because of unchecked confidence and hidden debt, what hidden risks are lurking in today's financial systems? It's kind of a haunting question, isn't it? Thank you so much for joining me for this explainer. I really hope this deep dive helped bring this massive historical event into clear focus for you. Please let us know what business story, financial scandal, or corporate giant you'd like us to tackle next. Your suggestion just might be the next topic we dive into. Stay curious and keep learning.